But I do think in all circumstances, gold is getting market share in the sort of neutral reserve asset category over Western debt.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 2nd through September 9th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Doomberg from the very popular Doomberg Substack, the #1 paid financial contributor on Substack. You can also find him on Doomberg.com. Doomberg, thank you so much for joining us today.
Elijah K. Johnson, how are you, my friend?
Well, doing great. It's great to have you today. We had a lot of viewers' questions submitted here, so we might just jump right in. We have quite a few questions on precious metals. So before we get on to that, maybe if we can get your broad overview of what you're seeing in the precious metal space. I know gold has risen quite dramatically and silver over the last, I guess, since the beginning of the year, right? And gold making new all-time highs. So your perspective on maybe why gold is moving so fast.
I should start, I suppose, by saying that I am personally uncomfortably long gold, which makes me a relatively unbiased observer of the gold market, depending on your views. We view gold as primarily a means to store value, i.e. to put excess savings. But recently, with gold, I'd say gold probably in the sort of 2,200 range, we sort of expanded our allocation within our savings budget away from a few other possible investments and into gold. With gold where it is now, I never intend to sell my gold. I intend to sort of pass my gold down to the next generation. And so I don't really look at the price of gold except for opportunistic buying opportunities. But up here, I wouldn't be allocating incremental savings to gold right where it is. And I'll give you a couple of reasons why. First, it's been on a pretty long run and nothing goes up and to the right forever. And I think a little bit of consolidation might be healthy. But also the premium in Shanghai has basically been arbitraged out of the market. We've seen headlines in the past few months that the Chinese central bank has put a pause on its acquisition of gold. Some people doubt those headlines, especially sort of perma gold bulls, the people who try to read a bullish narrative into every headline. We saw those headlines cross our Bloomberg terminal and in conjunction saw the premium to physical gold in Shanghai versus London and New York shrink to effectively zero. And that causes us to, well, said another way, if that premium drove the price higher, what does the lack of such premium mean for the next 3 to 6 months? And so if you don't have a gold position, is now the best time? I suppose if we have a breakout past the all-time highs, it could go on a bit of a run. We are going to keep the gold we own, but we are cautious in the medium term on precious metals.
No, that's very interesting that Shanghai premium has pretty much gone to zero here. We do have a question regarding silver. The viewer asks, how high could silver go and at what time would be the best to sell? Is there a safe cutoff point and would the silver then tank? So it sounds like what you're saying now is you're maybe cautious right now.
So silver is a different market than gold. And I think we've discussed this before, but it's worth repeating for the person who asked this question. Silver is over time becoming less of a monetary metal and more of an industrial one, driven predominantly by gold's reemergence as a potential neutral reserve asset for the settlement of international trade. There's nobody talking about using silver, for example, as a reserve asset. Central bankers aren't hoarding it. But more importantly, I think, is that the marginal ounce of silver is being directed towards the solar market. And there's a fair amount of silver in solar panels. I think I read, and don't quote me, I guess I'm being quoted, but I think it's 20 grams of silver per square meter of solar. The world's installing a lot of solar. So when you are making an investment in silver or allocating some savings to silver, because there are still some people who think silver's predominant role is as a money metal, we disagree, which is why we don't own it in any meaningful size. You are making a speculation on the future of the solar industry, effectively. And so that's not a speculation that we would be comfortable embarking upon, long or short. I would say that the gold to silver ratio is something we look at, is a pretty strong indicator that the green revolution, quote unquote, is probably going to dissipate, because nothing in the markets that matter for solar are behaving in a way that would indicate that solar is dirt cheap and we're at a tipping point and the era of fossil fuels is over. And so the concern that I have with allocating a fair amount of money to silver is that it's also very volatile. It's sort of like natural gas compared to oil. It's a hard market to trade. One of the devil's trades. But it's just you're speculating on solar. And we don't speculate. We earn and save and invest privately. And so gold gets the allocation of savings in total that silver might get a part of if the circumstances were different.
Now, when it comes to platinum, I know we've gotten your perspective on this before. We do have two viewers' questions on platinum, though, and it does present an interesting anomaly where we see platinum more than half of gold's price, which we really haven't ever seen it at this ratio to gold. Two viewers are wanting to know about platinum. Robert wants to know, what is your perspective on platinum as a holding? And the other viewer wants to know your perspective on the platinum gold ratio.
Yeah, so that is a market that I would say up front, again, I have not studied very carefully. I know that platinum is used in emissions control applications. So it too is one of these quasi precious metals, but for the marginal prices driven by supply demand dynamics in what are basically industrial markets. And so just to give you an example, like some improvement in an emissions control technology that requires far less platinum could cause the price of platinum to drop substantially. And those just aren't markets that we follow. The platinum market also, I think, I would imagine, has substantially smaller volumes than gold and silver. It's not I would say it's a distant third in the precious metals podium. And so it's just not one that I know all that much about. And so I'm relatively uncomfortable giving a definitive answer to those questions.
I know you focus quite a lot on the energy markets, and one of your latest blog posts was about OPEC and it ending. So I was wondering if we could maybe discuss energy in general, and also what do you think the end of OPEC would mean for energy prices going forward?
Yeah, great question. We wrote a piece not necessarily predicting the end of OPEC, although that is the sort of tone of it. The piece was titled "How OPEC Ends." In other words, what are the milestones? And I believe the social preview for that piece was marking the inevitable demise of the world's most important cartel. It will, like all cartels, eventually fail. The fundamental flaw of cartels is that they maintain a higher price for the underlying commodity than would otherwise be, and eventually the forces of arbitrage win. Eventually might mean decades, it might mean centuries, but the thermodynamic endpoint is something that you can be quite certain of. The manner and the signs that we see in the market that motivated us to write the article are consistent with the whole series of articles that we wrote on the subject of peak cheap oil, which is this blurring of the definition of oil. As the world is flooded with lighter and lighter hydrocarbons, we are either manipulating those molecules to make them look like oil or changing the engines out in order to burn those molecules instead of oil. And it doesn't take much intra-market penetration for the forces of arbitrage to close. And right now we have a generational arbitrage, which is actually the name of one of our earlier pieces on the subject, where in the North America in particular, the price of natural gas is selling for $10 or $15 a barrel equivalent on an energy content basis. And that can't stay that way forever. And we predicted in that piece that we would see engine switching, but like with most things, China is operating at China speed, and it is switching engines at an alarming rate if you're long oil. I noticed a few high-profile content creators came out with a bullish oil call earlier this week, perhaps even on the same day that we published How OPEC Ends. We would be cautious oil from here, and I think the price action this week since we published that piece is pretty consistent with that. And what we're seeing in China, and as we said in the piece, How OPEC Ends, fully 1/3 of all of the new long haul trucks in China were powered by natural gas in April. Most of them powered actually by LNG. And one of the drivers for that, as we talked about in our Doom Zoom, the Year of the Dragon, China Through the Lens of Energy, which was also recently published, is that the CCP cares a lot about pollution control, especially in the cities. And two of the main drivers of pollution in the cities, the PM 2.5 measurements and all of the nasty fog that you see during the days there in Beijing and Shanghai. That's driven by the burning of coal and then wind patterns, but also, to a large extent, the burning of diesel in those cities. And if you replace a diesel truck with a very cleanly burning LNG truck, that's demand that's basically gone forever. And in a very short period of time, China has displaced, according to numbers I saw from Goldman Sachs and then I believe a separate report from Bloomberg, somewhere between 800,000 to 1 million barrels a day of diesel, not oil. Diesel is a refined product. So that's basically, 3 million barrels of oil, just rough numbers, but 1 million barrels a day of diesel is material. It's like 3% of global diesel demand. And 3% in the highly inelastic markets for primary fuels is enough to materially dampen prices. And again, once that switching happens, it tends to be hard to get back. Like if you invest in an LNG truck and you happen to have the benefit that your local CCP representative is happy that you're not polluting the atmosphere with poor diesel controls on your truck, you're not going to go back unless prices swing wildly. Well, right now, diesel is more expensive than even LNG, let alone pipeline natural gas coming into China from, Turkmenistan or from Russia. And so there's a giant headwind to the price of oil right now, which is the combination of dirt cheap natural gas all over the world and the technical and economic switching that is occurring, which we had predicted in our various pieces in late 2023 and early 2024.
Now, when it comes to LNG, we have a viewer, Edvard, is wanting to know about the arbitrage between North American markets, Europe, and Asian markets. How do you see that playing out for the next 2 years?
If you look at the price of natural gas in the US, it is still effectively zero. There are great swaths of areas in Texas and Western Canada where natural gas is trading. Oftentimes spot prices trade at or below zero. And it's a pretty valuable molecule. It's a little more, difficult to handle than oil because it's a gas. It's right in the name. But I'm just pulling up prices today, for example, in Alberta, natural gas is 66 cents per million BTU, which is the equivalent of $3 a barrel oil. And in the Permian, prices are negative today. Spot price at the Waha hub in Texas is minus 27 cents per million BTU. So if you have a very high energy density, very clean burning fossil fuel that is free, you're eventually going to take advantage of that. Now, LNG is different because you have to chill it at an export terminal, put it on a boat, and then it floats on the ocean, and then the highest bidder gets that cargo. That's a bit of a simplification. Of course, there are long-term contracts and all these other things. LNG, landed LNG in Europe today, is trading for $12 a million BTU. And if you multiply by 6, just for round numbers, that basically means that landed LNG is trading for $72 a barrel oil, which is where Brent is trading this morning as we talk. So the arbitrage between LNG and oil has closed. Landed LNG is trading roughly for the same price of oil. And in those countries, oil is burned for electricity and natural gas is burned for electricity. And there's enough intramarket penetration that you can switch. And so that's sort of the equilibrium price. And by the way, that tells us, interestingly, that the geopolitical risk premium of oil seems to have been pulled out of the market, which was one of our sort of temporary measures of geopolitics. So the arbitrage has been squeezed out of the LNG to Brent comparison. But in the US, there's still an enormous arbitrage to go. And China, while it does import natural gas via LNG, the sort of blended price of its pipeline gas from Power Siberia 1 and the pipeline that originates in Turkmenistan, And their own domestic production is far cheaper than LNG. And so it makes sense for them to run their vehicles on natural gas instead of diesel. And these are one of the fascinating things about the energy markets is, I mean, energy is life, energy is fungible, energy is inelastic. And because of those three things, energy is relatively predictable. And so if you study the markets close enough, you could see these trends. And you can have an advantage of knowing where the market should go. So in our view, and we've had this call on all year, the energy markets are very well supplied. We are relatively bearish oil. And unless and until the market clearing price for natural gas in the major natural gas producing countries like the US and Canada, ascends higher, then the oil prices have to come lower. The jaws of arbitrage close lower in a glut. And we have a glut of natural gas in the world today.
Now, when it comes to energy markets in general, we have a viewer wanting to know how you see the interplay between current geopolitical tensions and global energy transitions affecting the energy security and market stability over the next decade.
A good friend of ours, Sir JJ, as I call him, Jack Johnston, who has a great new Substack, whose name I always have difficulty pronouncing, but maybe I'll send it to you afterwards and you can include it in a link. He had a great quote the other day in one of his pieces, which is that, and he's just as context, he's a longtime veteran of Wall Street, 40 years of experience in precious metals and energy markets. And he noted that there was an oil tanker that was blown up by the Houthis and the market didn't care. Back to my earlier point about the geopolitical risk premium being squeezed out of LNG versus Brent, I think the market has digested what's going on in the Middle East, and rightly or wrongly, it's currently pricing in very little in the way of massive geopolitical risk. In other words, despite all of the provocations on both sides, it looks like Israel and Iran are not yet in a hot war, and the U.S. actually seems to be proactively trying to mitigate that risk. Contrary to the current regime in Kiev's demands, the U.S. did not grant that regime permission to launch Western-made missiles into the deeper parts of, what everyone would agree is sort of traditional Russia, all the other border disputes notwithstanding. And so it seems like the market has decided that war risk is coming out. And as you and I had spoken about on multiple appearances, one of the bearish headwinds for oil is peace, because it takes that risk premium out of the market. And so I can only tell you right now that crack spreads are on the floor. They are not signaling strength. Calendar spreads are screaming weakness. OPEC just reversed a decision to increase, or at least to publicly state that it reversed a decision to increase production, which is not a bullish sign. The same Sir JJ this morning had a great line that oil is dead catting, which is basically saying it sort of popped up a little bit, and he thought that that little rise in oil was suspect and could be faded. And so as we look at the board today, now some contrarian investors would say if these are the signs of an inflection point, you have crack spreads, refiners not making any money, the market is oversupplied, the perception of geopolitical risk has minimized. Maybe this is the time to get long. I don't see what the catalyst would be other than some unexpected and therefore unpredictable and therefore untradeable sequence of events that suddenly arise.
Now, when it comes to moving gears here, we have a question here on the BRICS. Now, there's been quite a bit of talk, and we've talked about it before, about this idea that the BRICS may have a currency in the future. Caleb wants to know what you think about the BRICS nations. Can they roll anything out with a currency or bridge even sooner than the U.S. thinks? And do you think they're waiting for the right time to cause the most damage? For example, during a rate decrease or easy money cycle?
Great question. Before I answered, I wanted to give Sir JJ Substack metals, oil, and everything else, and it's Alyosha, Alyosha. I hate to quote people's work without giving them the appropriate plug. A great Substack to follow. He writes a morning and evening note, and I highly recommend it. To the question of BRICS, I'm not sure that the quote unquote currency is what matters. What matters is the collaboration. And it does seem like a critical mass of countries are collaborating around a new system of international trade that de-emphasizes the power of the dollar and the risk of being sanctioned by the US Treasury, and re-emphasizes the power of gold as a neutral reserve asset. And as our good friend Luke Groman has been writing about for years, the US Treasury is no longer considered neutral. It might still be a very significant reserve asset, but it's no longer neutral. The sanctioning and threatened seizure of Russian reserves means that Western debt, which used to be considered risk-free, is certainly not considered risk-free by many of the nations involved in international trade that have either recently come under or might soon come under the or find themselves on the naughty list from the US perspective. And the comings and goings in Venezuela and so on and all this stuff is feeding the narrative. We noticed with interest that Turkey seems to be willing to apply for BRICS membership. We are going towards people call it multipolar. I think it's going to be a bipolar world. There's going to be BRICS and there's going to be the G7. The so-called Western world, maybe it'd be more than 7, maybe most of the members of the G20. But even within the G20, I think basically, which is an organization that kind of has to dissolve, there's significant participation in BRICS amongst those countries. And I don't think that they're like conspiring to weaken the West. My view is that they sincerely would like to manage their own affairs outside of the sort of Atlanticist sphere of influence. And China, Brazil, India, Russia, they all have complicated relationships. Like this is a sort of a classic shotgun wedding. I mean, if they weren't forced into this situation, it's not at all clear to me that they would be deciding that the enemy of my enemy is my friend. But that seems to be what's going on now. So just as a small example, I mean, it's not clear that China and India would ever really get along. They have border disputes and a long and ugly history. The same in reality with Russia and China. A key milestone, I think, forget about the currency and forget about the timing of it and all that stuff. If you want a true milestone test for whether the quote unquote BRICS countries are serious about truly challenging the Western order and dividing the world, bifurcating it into BRICS and the wealthy West, keep a close eye on the Power Siberia 2. This is a large pipeline that actually would effectively permanently re-alter energy arteries from Russia to Europe, away from Russia to Europe, towards Russia to China. And China has been hesitant to go forward with that project, in part because it worries about concentrating its own energy risk with Russia. As close and as friendly as those countries and their respective leaders might seem now, that is a bit of a quirk of history. It wasn't always that way. We found it very interesting that Vladimir Putin visited Mongolia last week for 2 reasons. One, Putin has been charged by the International Criminal Court for war crimes in Ukraine, and Mongolia is a signatory to the ICC. In other words, it is obligated to arrest him. And he traveled to Mongolia and was given a hero's welcome. And spoiler, he wasn't arrested. But most importantly, the Power Siberia 2 would go through Mongolia. It would start, in the sort of northern Russia in their prolific gas fields, and it would take gas that had previously been sent into Russia via over the land pipelines in Belarus and Ukraine, and also Nord Stream, famously. All of that, no, a fair amount of that gas would go to China directly via the Power Siberia 2. If the Chinese relent and they join this project and the Power Siberia 2 gets constructed, then I think BRICS are actually very serious about going forward. That's sort of a off-the-wall call on our part, but as a milestone to assess that BRICS is for real, far more important that they get their energy act together than it is about, whether they have a common currency or so on. But I do think in all circumstances, gold is getting market share in the sort of neutral reserve asset category over Western debt.
Now, a lot of people have been talking about reset in the way the global monetary system works, right? And what you're talking about right now, I guess, could be considered a reset where we're going from a unipolar world to a bipolar world. I wanted to ask you if you see anything further than that happening. We have two questions, and you can answer them how you'd like. But just to kind of bring the viewers in here, Elias wants to know, does all old government debt need to be paid off before the reset happens? He asks. Also, Aaron wants to know, rumor has it that America is getting a new currency, new money. Do you have any thoughts on that? So I guess broad question, do you think there's anything more to this, rumor that there's going to be this reset coming in the future?
So you start with the axiom that it is impossible in the current structure to repay the debt that the Western world has accumulated. Okay, like that, like everybody knows. Now, what really matters, of course, is not repayment risk, it's refinance risk. And the key need of the indebted nations is to avoid a circumstance where they can't roll what's coming due. Famous line that I first learned from Kyle Bass on Twitter, who knows where he got it from, but a rolling loan gathers no loss. And so nobody expects to be repaid, but they do expect to be refinanced. Like in the great financial crisis of 0809, it wasn't, the investment banks that went under just couldn't roll their paper. They relied on short-term funding in the repo markets or wherever, and everybody thought everyone was suspect all of a sudden, and the whole thing seized up, right? And so that's the risk that you actually want to avoid. And I think one of the reasons why we have allocated so much to gold, and again, gold could collapse in half if we're dead wrong. And so this is not investment advice and all this other stuff. One trick for the Western world to suddenly become more solvent is for everybody to wink, wink, and agree that the price of gold in dollar terms, in euro terms, in yen terms, and RMB terms needs to be much higher than it is today because they all own gold. And that suddenly makes the asset side of their central bank balance sheets a far more solvent. I notice I didn't say solvent in the absolute, but they're closer to solvent, which makes it easier to roll. So I think there's a world where we wake up one day and gold is measurably higher. That maybe it's a slow climb up, maybe it's all at once, but the US owns a lot of gold, Britain owns a lot of gold, China owns a lot of gold. China is very indebted, Japan is very indebted. A lot of the debt in Japan is owned domestically and all that jazz, but still, if we could revalue the gold holdings, assuming we still have them here, overnight, then suddenly everybody is solvent again, and all of the gold bugs get paid, assuming it's still legal to own it.
Now, one last question we have has to do with immigration, and I guess this might play into kind of the shifts we're seeing globally. John wants to know, with the massive immigration issues in Western Europe and the US, how do you see this playing out over the short, medium, and long term and its effects on society?
Immigration is an interesting question. And since we own an energy hammer, every topic seems like an energy nail. But actually, I think the frictions around immigration, which are often cast in the media along racial or identity political terms, we actually think it's just BTUs per capita. And so if you look where the immigration issues are the loudest, like the US has an immigration issue at the border, but it doesn't really dominate our politics. It dominates politics in Germany. It dominates politics in the UK. Why? Well, those are energy poor countries. And if you're flooding your country with people from other parts of the world and you're screwing up your energy policy, then it necessarily follows that the BTU per capita is going to go down. And as we've said before, energy is a measure of your standard of living, and everybody everywhere wants a higher standard of living. And on the path from abundance to scarcity is riot. And so I don't think those two things are disconnected. And in the US, which is a global energy gigapower, we are absorbing, far many more millions of people than some in the country would like, but it's not materially affecting the sort of BTU per capita in the way that it is in Germany and the UK. And, maybe our analysis explains half of the problem, not all of the problem, but I think that's an interesting variable that few people talk about. If you're energy poor and you're artificially increasing your population, the incumbent population, regardless of their heritage, is going to be upset about it.
Now, before we let you go, Doomberg, our viewers can find you on Doomberg.com. We'll put a link in the description there. Highly recommend people check it out there. Any last thoughts before we let you go? And can you tell us a bit about your service?
Yeah, no, great to see you again, as always, and always enjoy our conversations. Doomberg.com, we have 2 tiers. $300 a year gets you our minimum commitment of 84 articles, although we routinely write more than that. And then $1,200 a year gets you all of that, plus our monthly webinars, which we have spent a fair bit of time developing over the years, and they're a lot of fun to put together. And a Pro tier membership unlocks the full history of those presentations. Last month we did Year of the Dragon, as I said earlier, China through the lens of energy. We've got a great one coming up for this month. We haven't announced it yet, but the tentative title is Water Everywhere. We're going to do a deep dive on the water market, which is a real derivative of energy, and teach our Pro subscribers how to look at the water market in a way that they might not have thought about prior. But everything at Doomberg.com, all of our podcast appearances, even just signing up for free, you get the great previews to our articles. And maybe after reading enough of those, we might be able to entice you to open up the wallet and join us on the paid side of the ledger. So great to see you again, Elijah, and looking forward to our next conversation.
Fantastic. Thank you so much, Doomberg, for your time, and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 2nd through September 9th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.